Good afternoon and welcome to the FINTEL PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Neil Stevens, CEO. Good afternoon, sir.
Hello and good afternoon, everyone. Thanks for joining us and thanks to Investor Meet for hosting us. I'm joined today with my co-board colleague and CFO, David Thompson, and we're delighted to be able to take investors through the financial results for the full year of 2023. If you're not familiar with our sector, it's worth spending just a couple of minutes to talk about what a wonderful, vibrant and full of opportunity sector retail financial services is in the UK. There are thousands of choices facing consumers to protect their wealth, their property, their families, their incomes, their retirement. And many hundreds of product providers offer fantastic products in a very competitive market. This drives great consumer outcomes because the market has great competitive forces, lots of innovation, lots of choice for consumers. But decisions are complex. Trying to figure out what you need and who can provide it is tough. And because of that, over 80% of all retail financial services products outside of simple banking and mandatory insurance are purchased through intermediaries. These are the professionals who help the customer understand the problem and solve it with a good financial product. This market is heavily regulated for many years, mandatory regulations being in place, and that regulation covers the products themselves and the way they're marketed to and advised to customers. The market's really fragmented as well, quite different from the European market as an example. The UK market is made up of thousands of smaller firms, all professional with the customer as their main concern and the agent of the customer, and a real need to obtain high quality data to understand all the changes that are happening in this market, the different products, the different legislations, and the different needs of customers. And because of that, over many years, we've ended up in a market where there's lots of different unconnected technology solutions that try and solve all these problems. We think that's a really great place for FINTEL to solve problems. We offer all the participants in the market regulatory support, connected data and technology they need to get the job done, and the UK's most comprehensive product information and comparisons. And we bring together all these different need areas into one platform to help get better outcomes from retail financial services. We have three main customer groups. The product providers, we help them understand the market, we help them access the market, and we help them design and manage their products to get the best outcome. The professional intermediaries, we provide them with the regulatory expertise, help them run their businesses and the technology they need to look after their customers. Product research, financial planning, integrated workflows, all the things that help a financial intermediary serve their clients effectively and profitably. And we provide indispensable services to the consumers, helping them understand financial products through our ratings and our reviews, help them to make comparisons and to educate them on the needs and the problems they have and how financial products can solve those. We want to help consumers make smarter financial decisions. And because of the way we work across the sector and across these customer groups, we're able to learn new things and to use that knowledge to inform the other market areas that we're in a big virtuous circle. Understanding the needs and preferences of consumers, the methods and business practices of the intermediaries, and the products and strategies of the providers, and how these things all interact as the world keeps changing. So over 20 years now, FINTEL has built up and bought up the most comprehensive platform for intermediaries to run their business. the things they need to do the practice management, and all of the things they need to advise their clients through a connected platform of technology. There are thousands of small and medium and some larger intermediary firms in the UK who all have common needs for these different areas. And Fintel is the first company to offer a connected platform, a one-stop shop that someone can come to and get everything they need to operate. And we think this is a really solid strategy to continue and accelerate our growth and value creation in the sector. 2023 was a year of continued progress for us. We had strong financial performance with core EBITDA growth of 9% and a really strong EBITDA margin as we continue to offer high value services that are high profit. We've grown our dividend again, as we have done since launch, 6% dividend growth compared to the prior year. And we've been able to significantly accelerate our strategic delivery by making big investments in our organic technology and services and completing 6 acquisitions, 4 in 2023, with a further 2 just after the year end date. And indeed, we've been busy this week as well. So I'll have a few things to say about that. We continue to win absolutely flagship partnerships with some of the biggest names in financial services. A couple of highlights for us in 2023 include a big contract with BlackRock, a big extension with Money Supermarket, and the development of HSBC's protection products on our platform. We are absolutely delighted to be number 14 of the best financial services companies to work for as well. Incredibly important are our people and the culture that we've fostered at Fintel. And so a great year in terms of financial performance, developing the platform and positioning ourselves for 2024. Very high quality recurring income, great cash generation with underlying cash conversion remaining strong, even with a strong investment mandate. And we believe we are underpinned by very positive market dynamics we'll talk a little bit more about as well. At this point, I'll hand to David, who'll take you through the financial summary.
Thanks, Neil, and afternoon, everyone. So just to zoom in on a couple of things Neil was mentioning. At our recent, well, not so recent now, Capital Markets Day a couple of years ago, we set out 3 financial KPIs that underpinned the really sticky business model that we've got, and they are to balance revenue growth, revenue quality, and profitability. So we decided that the 3 KPIs were core revenue growth at 5 to 7% a year compounding, core adjusted EBITDA and profitability between 35 and 40% margin, and the mix of revenue that comes from SaaS and subscriptions being the stickiest and longest tenure revenue between 70 and 80%. And you can see here the good progress that we continue to make across all those 3 financial metrics. So if we zoom into a bit more detail on the first one, which is the revenue, you can see there working left to right, we've bridged the revenue growth year on year. So the first leg is the core organic revenue growth, and that's up 2.5 million or 5.6%. So again, in that 5 to 7% corridor that we seek to do. We also added 1.5 million of revenue from the businesses we acquired in the period. And on an annualized basis for FY24, that will be 6.6 million. So again, over 10% growth added from inorganic sources in the year to come. We have a 2.8 reduction in revenue from an accounting change to one of the key software reseller contracts we have. And at its simplest, 2.8 million comes off revenue and off cost of goods sold, because we're now on a agent basis rather than principal basis, because we've managed to reduce the exposure to inventory and credit risk. So, important to draw that out. 1 million reduction in revenue comes from there's a part of our business that's a bit more transactional when it relates to the support we give to mortgage brokers, whereby we do lots of great subscription type services for them, but we also take a small clip of the ticket on each and every mortgage that they write. So that is a transactional style revenue that is a derivative of the UK housing market, and that dropped 20% in 2023, and therefore that revenue fell from 5 to 4 million. So again, if working back from left to right, the core organic growth at 5.6%, we're pleased with that. It's in the corridor with more inorganic revenue to come. So we're happy with the revenue. Just to look at the revenue in a slightly different way, that's the revenue stack, and you can see there that the most important driver of value is the SaaS and subscription revenue, and that's the bottom green section. And you can see that extended from 65 to 66%. And on a full year basis with the acquisitions, we'll see that trend up towards 70%. So achieving another one of our medium-term financial targets, which is great to see. And finally, if we look at profitability in each of the segments, we can see that essentially it's almost a 50% gross margin in every one of our divisions now, primarily driven by operational gearing and the fact that as we move to sell more products in the shape of software licenses, they are near 100% drop through cash margin. So as the operational leverage kicks in 24, we'll see the gross profit of the business go up to 55 to 60%. And that flows through to an EBITDA margin of 36%, again in that range. So we're quite pleased with the performance in FY23 because we're either ticking or about to tick each of our 3 core financial KPIs. And what that does is it turns very readily into cash because of the way that 2/3 of the business is on a SaaS subscription monthly direct debit basis. Now, what this slide seeks to do is it shows that the company IPO'd in 2018, and 10 months later, for 130 million, 10 months later, we acquired De Facto for 75 million. That was a large acquisition relative to the IPO size. Now, that was affected through both debt and equity, and at the point of the day one acquisition of De Facto, we had about 30 million of gross debt and about 2 tons of leverage. And really the impetus on the business was to delever as quickly as possible and integrate De Facto really well and cross-sell the services to our existing customer base. And you can see there that by the half year in 2022, we'd paid off the last of the debt, and De Facto had doubled its EBITDA from just over 5 million to just under 11 million of EBITDA. So again, 3 stripes on the shoulder for doing a great job of making a big acquisition, integrating it well, and demonstrating that the business can delever quickly. The second half of 2022, we had an excellent balance sheet, albeit the cash generation means we were just going to build cash, and it was time for us to invest for growth again. And that's exactly what we've done in FY23 with the number of acquisitions that we've made, again, to fill that one-stop shop for the IFAs in the wealth space. And we'll go on to do that in the mortgage market, and Neil will tell you a bit more about the mortgage brain investment that we've made this week. So in order to give a bit more granularity on the investment, you can see there that our cash balance of 12.8 million last year and 12.7 million this year doesn't tell you the story of the cash generation of the business. So again, working left to right. So the business generated just under 20 million of cash from operations. We drew 11 million of the 80 million revolving credit facility, and we received 600,000 of deferred consideration from a disposal we made in 2021. So that gave us over 44 million of cash resources. And on the right-hand side of that is how we've used it, how we've invested it for shareholders' interest. So the first 4 sort of lime green sections are investment, be that acquisition, development expenditure, other smaller investments in different businesses, and that totals well over 20 million. We've paid a 4 million dividend in the year to all the shareholders, paid 2.8 of tax, and there's a £500,000 non-utilisation fee for access to the 80 million revolver. So that's, from the really strong cash generation, that's how we've invested it in 2023 to further drive growth throughout the business. And one of the key metrics we also look at internally is cash conversion. And really this is a yardstick to make sure that we're controlling working capital well, and that we sensibly deploy internal investment as opposed to external acquisitions. And you can see there that, again, in the face of a more than doubling of our development expenditure internally, we've still got an 88% underlying operating cash flow conversion. Our medium-term goal is to have that between 90 and 100%. And again, so the ongoing investment will be 4 million over the next couple of years, and that will see us firmly in that corridor. So the fourth underpin of the profitability and revenue growth targets is converting it into cash, and we're going to tick that box as well going forward. So in summary, on FY23 itself, very clearly a resilient financial performance in a macroeconomic environment of high inflation, climbing interest costs, but that work that we've done since the acquisition of De Facto to get the business into a really strong position from a balance sheet strength and liquidity standpoint has really helped us grow and invest. We've got increasing revenue quality in the core business, so more than ever before, the amount of revenue coming from SaaS and subscriptions that are the stickiest revenue source. That's the highest mix we've had. We've seen the strong cash generation, but you've also seen how we deploy that. And again, as Neil mentioned, our progressive dividend policy, we've gone up 6% to 3.45 pence. There was a 1.1 pence per share interim payment, and a 2.35 pence per share payment will be made for the full year. And with that, I'll pass over to Neil, who'll do a bit more detail about the divisions.
Thanks, David. So I talked earlier about these different customer sets and how they are very interconnected. When we achieve growth and development in one area, it generates IP or opportunities for growth in the other divisions. It is, however, important each division performs well in its own right. And I think it's great to see yet again in 2023 strong divisional performance within each of the divisions. So intermediary services is, as it says, the services we provide to professional intermediaries. Vast majority of this is subscription revenues, signed, contracted, repeating monthly income, with the addition of software and digitization coming through as part of our strategy. As we turn more of what we do and know into software services, it strengthens both the revenue quality and it gives us more incremental margin growth as well. Good growth in profits, good growth in additional services as we roll out more support for our intermediary customers. One thing that remains constant is changing legislation. And so every period, the regulators and all of the regulators that have an effect on this sector make changes that intermediaries need to get up to speed with. The FCA brought the consumer duty in this year, through last year into this year. Massive piece of legislation that has a huge effect on the way businesses run and what they must do for their customers. And so that, of course, has meant we've been able to provide new services, expand our offering, look after our clients basically to make sure they're successful. We continue to invest in RegTech. We've got the best team in the industry, brilliant people, loads of experience, fantastic culture. And in addition to having the best people, we're going to have the best technology as well. So that may be things that we're acquiring and things that we're building internally, using the knowledge, skills, working methods from our teams to build new software products and connect them up. And so great heart of our business, strong growth, really important strategically. Next is the distribution channels division. This is where we help product providers bring their products to market. Here we're winning some fantastic new contracts generally, and we're converting many of our long-standing customers over onto new multi-year distribution as a service contracts. In this area, it means that people, these big product providers, are signing up to multi-year deals where they commit to purchase data and distribution services from us. And we have very forecastable, predictable cash flows and revenues. So it's been a big improvement in this area of our business in terms of the quality of income. We're seeing certain of our IP services really get scale. So strategic asset allocation is an example where we provide investment management companies with market data and data on portfolio allocation for client portfolios. And they pay us a license fee for using our IP in their products. And we're seeing some strong growth coming through in that, which I think will be a component of growth for that division going forwards. We also get fantastic engagement. Over 18,000 attendees at our events program last year. This market needs engagement. There are so many different products, so many changes in the market, and all these thousands of businesses to connect to. We're the conduit for that. We provide the digital and face-to-face training events and platforms that helps educate and maintain the CPD of the professional advisor market. And that's of enormous value to the product providers to have access to that channel and the efficiencies that our channel brings. And so another great year for distribution channels and a key component of growth for Fintel. And the third division is FinTech and Research. This was the de facto business we acquired and brought in. And as David has said, great results from being able to massively accelerate the growth of de facto, leveraging off the other divisions. We've seen good growth in organic revenues, even stronger growth in software revenues. We've been investing heavily into financial planning software. It's landed perfectly in terms of timing, with Consumer Duty coming in and the retirement advice review coming in from the regulator as well. We've pre-built the answers and the solutions that will keep our customers compliant, and we'll see that as a very strong growth driver in terms of software sales for the business coming into 2024. We also have seen continued significant growth in our product ratings revenue by acquiring the MyCap business and bringing it into de facto and extending our star ratings platform. We've been able to have a double win in terms of growing revenues and growing our engagement for product ratings across the specialized investment area, in addition to the investment trust work we've done as well. So more data, more product research areas, more rating services, just compounds the growth as we build bigger audiences and stronger software platforms. A quick word to say about M&A. We've been particularly active in the last 7 or 8 months after a period of being particularly inactive. M&A is one part of our strategy. It's important, but it is one component of growth. David talked earlier about the financial objectives we have. We set those out in 2020, in the December of 2020, right at the heart of the COVID lockdowns. And we set out a equity story for Fintel that could deliver consistently compounding revenue growth of 5 to 7%, whilst growing our margins to 35 to 40% and building high quality recurring revenues with very strong cash conversion. And we're delighted we're being able to deliver on that. Our guiding principles are around being customer-led and data-driven, building a great platform with fantastic people, and having strong brands in the market that really deliver the promise of value and promise of products that are high quality. Very clear about the customers and the markets we're in. We stick very close to the core. It's UK retail financial services. It's working across those 3 stakeholder groups, the providers, the intermediaries and the customers. And we see enormous capacity to grow and stick to core at the same time within that fantastic market we're in. We continue to digitize our services. We want premium products and premium pricing. We want to be the best at what we do and to charge appropriately for that. And as David said, in 2024, we're ramping up our 2023 and 24, we're ramping up our investment in innovation, and we're ramping up our digitization and product investments as well. So the strategy isn't just M&A. However, having had a period of not doing much M&A, the backdrop has changed, and it's been the right time to act over the last 7 or 8 months. The cost of debt has driven out a lot of the deal activity that was overpriced. It's also meant that companies who were buying with the only component of value creation being leverage have had to look twice at the activity in the market. I think businesses have been sold to their natural owner much more over the last 7 or 8 months. And the businesses we've bought, we believe we are the natural owner for those businesses. We can bring them onto our platform and create genuine value by operating them in our market with our customers and alongside our other products. We have a strong balance sheet and quality debt facility and a fantastic team who knows this market inside out and has the bandwidth to bring in these new products and businesses. We think we are uniquely positioned to unlock growth potential. We are very much owner mindset in this business. The tenure of our team is unrivaled. Matt and I have been running the business for a long time and working with our customers and partners for 20 years. And many of the other team members have very long tenure as well. And I think that does give us a very stable platform and a trusted platform and people to bring businesses into. And that strong reputation and the deep connections we have means that we originate the M&A. We don't buy at auction. We are working with founders, working with market participants, telling the story about how they could become part of the Fintel family, and that can create value. And I think that helps us originate some really attractive deals and buy things that, frankly, other people can't get access to. The deals we've done most recently are all strong in their own rights. They bring really powerful capability to our platform. They are connected to the things we already do and the things we want to do. And each of them brings their own customer bases. Now, there'll be loads of overlap across the sector between our existing customers and the customer sets of these businesses within each other as well. But it's just more touch points, more engagement, more data on what's happening in the market, and more abilities to connect services together. So that somebody who uses Vouch4 can easily access learning materials from Competent Advisor, or somebody who uses the technology platform in Synaptic can access the de facto modules and increase their engagement with Fintel more generally. I'll ask David to come back in at this point, and he'll just talk you through the financial scorecards of the acquisition, the acquired portfolio.
Sure thing, thank you. And again, provide quite a lot of voluntary disclosure here on the next couple of slides around, because essentially we're investing 20 million plus of shareholders' money, and it's quite right that they can, as granularly as possible, see what each of them is doing to benchmark any return. So you can see there, this slide has the contribution in the period from the point of acquisition. So MyCap and Competent Advisor are included from the midpoint in July, and AKG and Vouch4 were completed at the end of October, start of November, respectively. And we include the results from that point. So you can see the revenue, gross profit and EBITDA from each of the 4 acquisitions in the period. In total, 1.5 million revenue, which you can bridge back to slide 9, 500,000 of gross profit and 400,000 of EBITDA. And you can also in the previous slide see which of the 3 operating segments they fit into, so that you can track the organic and inorganic contribution individually and also see how each of them are doing. But we also wanted to, because we've been buying businesses from founders and not as part of processes, we've been able to have a really deep conversation with them about where they are in the cycle. And some we've bought on a day one multiple that's higher than our trading multiple, some lower. But the point of, we bought them for very good reason. And if you look at that bottom half of the page, that's what we have in the market for consensus for how they'll contribute for the whole of the current financial year 2024. So again, taking an extra step to show the return on each of the investments. So you can see on a portfolio basis, we'll have acquired them for 13.3 million of net upfront consideration. They will contribute 6.6 million, or just over 10% of revenue growth at core, and they will contribute 1.3 million, or similar high single-digit percentage to EBITDA. But most importantly, that 1.3 million EBITDA is just around a 10 times EV/EBITDA multiple on a blended basis. And that's a bit lower than what we're trading at the moment. So to use the sort of bluntest of rules of thumb, we're acquiring businesses on a portfolio basis at a lower multiple than our trading multiple. These all contribute to the highest quality SaaS and subscription revenues, which we're targeting to be between 70 and 80% as a mix of total revenue. So clearly we'd like to think they were value accretive, not only from a raw multiple arbitrage, but also from multiple expansion, because we're adding to the mix of revenues. So I'll pass back to Neil on that.
Thanks, David. Yeah, we're continuing, that in that vein. We've got an active pipeline of bolt-on and some more strategic M&A we would like to do. We've got the bandwidth in terms of financial resources and operational resources to continue to make that work. Strategic capacity to continue to originate very high quality deals that are very additive to the platform we're building, and the financial capacity through an excellent debt facility and very supportive shareholders as well, that would enable us to reach for the bigger deals, which we will only do when they're right. Tenure, I mentioned earlier, is really important. When we buy something, we think about its perpetual ability to create value and to be important as part of our platform. And so, we're very prudent about making choices and selecting the right acquisition targets. When we've done it, then we've got a fantastic team. And some of the acquired teams that we've brought into the business are part now of that strong team, capable of delivering M&A and value creation in the way that's consistent with our culture and reason for being in the business as well. The M&A strategy is very targeted. We want to buy things that fit the bill of what we've described: high quality income, premium products, premium pricing. We want to make sure we're buying SaaS and subs that's high margin and very cash generative. It's got to fit the platform we're building and be additive to our capability set, give us that scalability and new data, proprietary data that is of value across all those different segments that we serve. We want to grow the customer base even further and make sure that we're taking our products to as much of this market as possible, because it really is the best stuff out there and people need it to be successful. Saying just a couple of words about the outlook for 2024 particularly. David mentioned the mortgage market has been soft in 2023. In our books, there's 1 million of revenue suppression directly related through the transaction volumes of mortgages. And that's really high margin business as well. We believe there are strong signs the mortgage market will recover quite well this year. There are 1.6 million fixed term mortgages coming up for renewal in 2024, which is 1.6 million households who've got a really important decision to make. And 80% of those decisions will be made with a professional mortgage broker. So we think, that should be a tailwind for the mortgage sector in the year to come. We're seeing the legislation driving real change in the way people run their business and the requirement they have to gather good quality data on consumers, consumer outcomes, and benchmarking themselves against other companies and competitors, we're perfectly positioned to provide those services and see it as being a strong tailwind of growth. The product provider market particularly has stronger demands for data and market insights, which we're investing in and developing and delivering more strongly in 2024. And the overall picture of financial advice is good. More advisors are seeing more clients with higher average portfolio sizes and greater scope of advice. And so our investment in better financial planning systems will accelerate our growth yet again in the year to come. I'd mentioned M&A is just one part of the picture. It's an important one, but those other things are equally important to us. Investing in the platform, digitizing our services, and delivering more data products, and growing the organic velocity with which we sell into the market. So very confident of delivering the 5 to 7% organic growth, which will be augmented by acquired growth. And thereafter, there's really big potential to add other components of growth as we bring a stronger platform together, launch new products, and potentially do larger enterprise deals as well. So lots of reasons to be cheerful and excited about developments at the business in the year to come. So I think at that point, we'll break for some questions, and it'd be great to hear your thoughts and understand the areas you'd like to explore with us.
Neil, David, thank you very much for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. Neil, David, as you can see, we've received a number of questions throughout today's presentation. Can I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Absolutely. So I'll pick one, and I'll let David pick one. So we'll share them out. So I can see Stephen K has commented a great business model. Thank you, Stephen, and asked what would enable you to accelerate growth. And so I'd certainly go back to my just most recent comments that the core business we have, we're confident of it delivering 5 to 7% revenue growth. The acquired portfolio will accelerate on that core organic revenue growth. And I believe there are more opportunities to grow faster by combining our products and creating new data products and doing larger enterprise deals. So as we're able to offer more of a platform rather than selling individual components to individual buyers in the market, we can do larger deals for a connected set of software to larger companies. And so that's something we're going to be focusing really, really keenly on in 2024. Stephen also asks as a supplementary, could you replicate the model overseas? And rather disappointingly, I'm going to say no, because we're UK focused only at this stage, and that is quite an important part of our strategy and an important part of my personal drive, as to what we need to do next. Yes, lots of software and IP in theory can translate to other markets. However, the devil's always in the detail, and we've seen lots of market entrants come to the UK to try and bring their software from the States or from Australia, try and bring their operating methods from other territories. And the localization is often underestimated to a great extent. The differences between different markets makes all the difference as to whether you succeed or fail miserably. And so at this stage, we're a UK centric, UK solely focused growth story. And I think that will continue for the next phase. And then maybe we'll get our heads up and think about it again at that point.
All right, so I'll take the next question from David S, who asks how we can leverage the recent acquisitions to drive further growth and market penetration. And I think slide 23 works really well here, so to complement Neil's answer of the enterprise deals where we sell the whole package. What we've also got here is look at the different intermediary customer sets that all overlap. So if you imagine a big Venn diagram of hot leads because they do content advising in their own James, but not Synaptic, etc., and you can look at that. So we've got a way of penetrating all of these customers that we have organically grown and acquired. It's a hotter lead. It's not a cold call, and you've got the ability to penetrate the market and look at enterprise license level sales. And then Marcus asks, I said again, compliments us on a really strong performance. Thank you for that. What are the target from recurring revenue as a percentage of total revenue? And that's between 70 and 80%. And just to answer that question. And again, a follow-on supplementary around how do you see the mix of organic versus inorganic growth with the high margins and cash? Are there larger deals that would be more significant? Well, absolutely. So you can see it's going to grow an extra 10%, both in revenue terms and profitability from inorganic to complement the organic targets. And that cash generation and immediate delevering effect means that we have about 60 million of liquidity as it stands to go and look at ever more acquisition of something in the mortgage space to complete the mortgage brokers one-stop shop jigsaw, and also look at customer acquisition. So we've got despite having completed 8 transactions in the last year, there's we're into our stride now, and we really want to do more. Neil, pass back to you.
Thank you. So Baron asks about integration. So how long will it take you to integrate the acquisitions that we've made? And when do we expect to complete development of an end-to-end platform? Well, I think there's a significant advantage we have in that we work with all of these businesses before we bought them. So Competent Advisor, Vouch for, Owen James, fantastic thought leadership platform. We used to co-host some of their events and provide facilitators. AKG was deeply integrated into De facto as a data source. And so we didn't come from a completely standing start. We've already got links and linkages that we've built for our customers to help some of these things join up. And I think by the end of the year, these businesses will come together and be one business with multiple products. So we've got a special dedicated team who are leading this. Some of the people on that team are coming out of the acquired businesses, and they've formed an overall board to bring them together. And some of the people who are doing that are people who are already with us. So, for example, the FINTEL COO has gone across to the acquired portfolio to lead the integration of the different products. So I think there's already integration there. And by the end of the year, we'll have a single offering, multi-product offering that will be there. Super. So I really thank you for your engagement, for the questions, and I hope if you know us already, I hope it was a good update. If you've not seen us before, I hope we've piqued your interest and you'll learn some more about what we're doing in the market. It's been a real pleasure to spend some time, and thanks again to Investor Meet for giving us a chance to showcase what we're doing.
Neil, David, thank you for updating investors today. Can I please ask investors not to close this session, and should now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of FINTEL PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.